You're in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. This week on The Biz, the Insurance Company Financial Review, and on today's show, the insurance industry statistics with special co-host, certified financial planner, and CPA, Ken Davis.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant. We're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, day 5, I don't know how he handles it, Mr. COU, CHFC, CFP, and CPA, and my good friend who's been in my little study group for like, what, a quarter of a century, Ken Davis. A quarter of a century.
No, I don't like the way you put that, Steve. It sounds even worse than 25 years.
Well, I could have multiplied 25 times 12 for the months and tell you how many months we've been together. Really.
Well, let's do the days while we're at it.
The days, okay. And how many shows have we done? No, okay.
Oh, gosh, too many.
Think about this. Today I'm talking about statistics, and sometimes people always ask me, hey, Steve, how many carriers are highly rated? And in specific, this is the number one question I get when it comes to ratings is, how many people have 100 on Comdex? Now, is that a surprise to you that people even want to know that?
No, I don't know. I think as a curiosity, I think it's something that people would like to know.
And I'm just talking Comdex. I have in front of me, by the way, the complete top 100. I could do all 700, 800, but I took the top 100 carriers and I asked for their AM Best, S&P, Moody's, Fitch, and Comdex, just as across the board. Now, interesting, Ken, and do you have the same list I have, right?
Well, not as much detail, but I've got Comdex.
But now you have the Comdex. Why don't you read off those first 6 to us and surprise everybody?
Well, I'm not sure I have exactly the same list. We've got Berkshire Hathaway.
Berkshire Hathaway. What is the Oracle of Omaha doing on this list?
Knights of Columbus, New York Life Insurance, Northwestern Long-Term Care, and Northwestern Mutual Life, Teachers Insurance and Annuity, and TIAA CREF.
I mean, think about that. Those are not names I would have thought had 100. I mean, there's a few in there, but I would have thought there'd be other ones.
Well, there's certainly not names that most of the public would pop up if you ask that question.
Well, when I look at this, when you look at this, I have another one where I'm looking at the total ordinary life in force. And there are 4 major insurance carriers that are sitting at 1 point something trillion. I mean, I'm sorry, but that number is gargantuan.
It's huge, and you know, we've been talking about financials, but another part of the big thing, and the rating services look heavily at this, is what are their underwriting standards and how good are they, and what are their claims experience. So that's the other part of the equation that they're looking at. We've been focusing a lot on liquidity and assets today.
Again, by the way, all these statistics that we pull off Vital Signs are all easily done. I mean, it takes but you can sort, you can ask for what you want. I'm looking for enforced. Sometimes I get questions, especially from consumers, and it's a kind of a tongue-in-cheek question. What happens if everybody died at once?
Yeah.
Well, you know, if everybody dies at once,
there's nobody to collect, so they're all dead.
I won't be there trying to help you with your claim, so I guess it doesn't really matter. But if you looked at if it was a monster tragedy, how much would have to be taken out? That's why it was so very important during 9/11, back when that occurred. All those people died at one time. And who were the carriers that had most exposure when that occurred, because that was an event. And think about this, everybody's death claim got paid.
Well, and that was a proud moment for our industry.
Oh, yes.
In that the fact that the insurance carriers in the contract had the right to require a death certificate. Well, we all know there's people buried in the debris that they hadn't pulled out yet, and they couldn't identify them. The insurance companies knew there would be some fraud involved in people making false claims, but guess what? They anteed up and they paid all the claims and then came back and investigated after the fact. I was very proud of our industry. And I'll tell you something else. I watched some newscasters talking about all the money that had been raised and donated. The people gave from their heart and put millions and millions of dollars into these things. It was taking them months to go through paperwork, stacks of paperwork for these people to get claims, and I'm thinking, gosh, how many insurance companies must have been in those 2 buildings? What if everybody in that building had at least $500,000? They wouldn't be standing there with their hand out begging for money. They wouldn't have to deal with their personal grief and the finances at the same time. And I so wish that the the journalists had taken that upon themselves and used it as an educational moment to let people know how important insurance is to the families.
Really, and I have to say this has been being in this business for 30 years. When I have delivered death claims, I'm the only guy going to a funeral with a check in hand. Everybody else is asking for their piece of the pie. Ken, when we're talking about carriers, I like to know who's selling what and how big a volume is it. And I'm looking at ordinary premium for about a 3-year period because it gives me a snapshot of where we're going with the carrier and how big it is. I'm looking at some of the top companies in the United States. Again, this is all on Vital Signs. When I look at this, I can see who is really pushing out premium, because the moniker out there right now is that the industry is flatlining in sales. Well, maybe total they are, but the players in the top 20, you know, they always say the top 20, right, 80% of the business, that might be actually true, but those top 20 are hitting some serious numbers and increases because they're innovative on product. And so you're going to see carriers that are coming across. When I'm looking at these numbers, they're huge. Now, we talked yesterday about return on assets. When I saw a couple of these carriers, I was stunned because I saw John Hancock themselves, which was, they had one of the best returns I've seen in a long time. Everybody was doing solid 6%, 7%. They were sitting there in double-digit figures. I was in shock.
How the heck are they doing that?
Well, I actually wrote them on that, and if you say, Steve, I'd like to know how that happened, I'll send you what they sent me. Wow. And you can write that at steve@thebiz.tv. To me, they should, and this is one of those times when you go, that story should be told, and why aren't they telling it?
Well, and the thing is, whenever I see above average returns when you're dealing with fixed interest rate assets, because they're basically huge bond funds, you have to ask about risk or if there's some other mitigating circumstance.
And there is, and if you'll write me at steve@thebiz.tv, I will send you that little explanation, which does have a bit of mitigation to it. I like that. I appreciate everything we're talking about because it's statistics that can help you win cases and position your practice. When we continue, we'll be talking about industry statistics with Ken Davis. And don't forget to go and test drive Vital Signs, absolutely free. Go out to the site, www.vitalsalessuite.com/logins/thebiz.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Ebix's Smart Office solution is used by thousands of professionals worldwide. Focused 100% on serving our industry, our proven technology has made us the #1 provider of CRM, practice management, and agency management solutions. Smart Office features include anywhere, anytime web-based capability, on-the-go mobile access, industry-specific functionality, integrations with key industry partners, investment data downloads, robust integrations with other Ebix products, and a high-powered email marketing capability through Constant Contact. Smart Office provides a complete wealth management platform that gives you the tools and flexibility to support your practice today, and an integrated advisor workstation designed to extend your solution as your practice grows. Make Smart Office the center of your practice. Get Smart Office today.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Ken Davis. And remember, you can order today's material at thebiz.tv. And while you're out there, click on the Backroom Technician icon right on the BizBlog section for their 30-day free trial offer for the best needs analysis and educational material that addresses almost every financial planning scenario. And just a heads up before moving forward with anything that you hear on our show, always consult your tax advisor or legal counsel, as well as your broker-dealer compliance officer if you're FINRA licensed. We're talking about industry statistics, yeah. And I'm stuttering with my statistics. Here's one, surplus and AVR growth, and one of the lead companies is actually a holding company, Guggenheim. Now, these guys have been on a tear on acquisitions and so forth, and I mean, and apparently they love annuity companies. They are really out there in the front right now, and there are several holding companies. The Salmons Group is another one. They're big, involved in actually their surplus and they have money to spend. So they're on the hunt. When I see people having huge surpluses, 20, 30% of their surplus and AVR of their total assets, they're looking for acquisition. And especially nowadays, you're looking at people who are saying, I'm looking for an annuity company. I'm looking for this company. They're targeting certain insurance carriers, and people who have money sitting in surplus and AVR are on the hunt. They're the predators right now in our business. So that's one thing, when you think about it, Ken, I look to there and say, those people have money to make acquisitions.
Well, I guess that's another thing too, is those that get too aggressive and their ratios are out of whack, they're the ones that when things go down get acquired by other companies.
Well, when I think about, you're looking at carriers that have not only surplus and AVR strength, and I mean serious strength, and then they have holding companies that are so strong. I always try to think about, well, why did that company, like why did Presidential buy, why were they bought by let me see, who bought them? I can't remember now. I just went kind of blank here. They were bought by Athene. And I'm looking at these. Why did they buy? They're an annuity company. They bought a life insurance company. Are they buying it for the book value? Are they buying it because they want to get into life insurance? When I'm looking at different carriers, I look at this and say, who's going to be on the acquisition hunt? And by the way, mergers now. There are a couple rumors out on the street right now. If a couple of these companies actually get together, they will go from I think it's the 13th and the 19th largest and move into the top 10. When I remember merger mania, remember when Connecticut Mutual and Mass Mutual joined together? I mean, these are kind of big numbers. New England was bought by Metropolitan. I mean, those mergers made these guys colossal. You started to see Lincoln buying Jefferson Pilot and things like that. There was a consolidation. I think we see a little bit of contraction, but I think you're going to see some consolidation again with surplus like this.
Well, think about, we were talking about it earlier. We have companies that are, B+ rated or BBB that still have very strong balance sheets, but they're downgraded just because they have one line of business. Well, wouldn't it make sense? I mean, if you're the CFO or the chief executive officer, say, hey, let's go start to diversify our portfolio by conglomerating with other companies that do things we don't, and suddenly our ratings go up because now we do have different distribution channels and we're still conducting business as we always have. It just gives us higher ratings, and we don't have to compete with quite as high an interest rate now and make more money.
What happens, Ken, when your surplus and AVR, asset valuation reserve, is $32 billion, and that's bigger than the lower tier of a third of the carriers in the United States in total assets?
Well, obviously that's impressive. I would caution our viewers to the fact that I don't really care if they've got trillions of dollars. The fact is, what is their surplus? What are their at-risk assets? What is their liquidity? Because I may have this massive company, but if they make some serious mistakes on a large level, they could be in trouble. So I really like, I look at liquidity is a big deal for me, and surplus is a big deal for me.
Well, Ken, I'm glad you brought that up. I have your answer for you. This company that has $32 billion in surplus, that is 17% of their total assets. Now, are you in love?
Yes, that's quite impressive.
I just wanted to make sure.
Doesn't sound impressive, does it? 17%?
No.
But that's huge.
In insurance world, it is to die for.
What is it, about average 5% or something?
It's like 6 something. Yeah, it's not very high. By the way, I spoke earlier in the thing about John Hancock. Their 5-year investment yield is 10.62. Everybody else, next guy is at 7.82. Ken, what kind of story? And again, people say, Steve, how do they do that? If you'll write me at Steve at the Biz, I'm a little
I love this tease, Steve. Go on here.
If you'll write me at thebiz.tv, Steve at thebiz.tv, I'll send you what they sent me. But honestly, really, John Hancock, way to go, 10.62. They're a major player. I mean, think about it. There's another consolidation. Manufacturers, John Hancock coming together. You're looking at companies that are actually, these are making numbers. These are huge numbers. And when I think about looking at what carriers are strong, and I see a number like that, and I put that in front of a CPA or a CFO of a business, and I'm down to a couple carriers, John Hancock being one of them, I'm showing this.
Yeah, and when you, in a sale like that, when you're talking, maybe the premium is, $500,000, and for an extra $20,000, they get that strength. Do you think they're going to blink at that?
No.
No, they're not.
Listen, all things being equal, when you say, most of the arguments at the bigger cases, if underwriting and the price tag of the product comes in view, it's little anomalies like that. They're going to separate you out of the pack, and you're going to be looking at carriers that you can position in your practice that can really make you look good. And again, how can you do due diligence across the board with all these carriers with a software package like Vital Signs by Ebix? I mean, I've been living off this since 1992. This is a huge package. The price tag is, It's so minuscule when you put about all the product that I've sold off it. And remember, you can take their free trial. Just look at that email address and go ahead and write to it. Remember, you can follow me on Twitter, Facebook, LinkedIn, or email me, steve@thebiz.tv. Well, that's the buzz on the biz for today. You've been in the zone, the Business Insurance Zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.